Hey, good morning. It's Ken Himmler, and I wanted to reach out to everybody today on this giant market drop. If you're watching the news, the Dow is down close to 1,300 points. NASDAQ is now down almost 20% since 60 days ago. So this is where you can test your ability to identify the type of investor that you are. So typically we talk about three types of investors. One investor is a market timer. They're looking at the markets and they're trying to determine the best time to buy in. Now typically what market timers fail to understand is that your emotion overrides sometimes the math, meaning a true market timer is looking at price to equity or price to earnings early morning, price to earnings ratios, and what they're trying to determine is not internal or external macroeconomic financial nervousness, which is what we're seeing right now because of the Trump tariffs. What they're doing is they're measuring where soft points are. You don't see Warren Buffett jumping in when the markets crash or jumping out when the markets are exuberant. He has a mathematical way to do it. So when we talk about market timing, if you get nervous when the market goes down or you get exuberant when the market goes up, that's typically an indication of you're a market timer. Even though most people that are market timers, they don't want to admit that they're market timers. Now, the second kind of person is the person that tries to find the next big Google or Facebook or Nvidia. That's a stock selector. And again, sometimes you run into the same problem, is that you buy certain investments, whether it's gold, silver, whether it's Bitcoin, or whether it's the next big high-tech item that you think is going to blow through the roof. And what happens is in these kinds of markets, because there's no real plan to understand what the earnings of that company are or what the long-term prospects are, people get nervous. When the market dumps like this, then what they do is they bag out, they sell out. And then the next time the market starts going up, then they have fear of missing out. So what they do is they buy back in again. Now, those two types of people are also the two types of people that are most susceptible to what I'm going to call the con pitches. The con pitches are, you go online and you see the world's coming to an end, buy gold, right? And you see a bunch of big names, authors that are doing that. And then you have the people that are selling annuities, and they sell purely through fear. And what's interesting about the annuities, now, please understand, I'm not saying that all annuities are bad and annuities are a terrible thing. What I'm saying is they're usually sold under fear instead of under a mathematical computation that, again, annuities should never be looked at as long-term, because typically the earnings on an annuity are going to far underperform taxes and inflation, which if you're trying to buy an annuity to avoid risk, you're actually incurring risk by buying the annuity because you're going to underperform inflation. So it can be a part of an asset allocation plan, but typically people fall susceptible to their fears of the world's going to come to an end, and then some annuity salesman shows up and says, well, here's this guaranteed product, and then most of the time they're promoting it's going to give you 6 or 7% increase every year, and then they are sorely disappointed to find out later that it's really about 1 to 2% after they take all their fees out. So two types of investors in this kind of market: one, the market timer; two, the stock selector. And then finally, who is the most emotionally stable person in this kind of environment? It's the kind of person that has an asset allocation plan. And I'm not talking about the junk that these big financial institutions tell you that you're diversified and you have an asset allocation plan. I'm talking about a plan that is predicated upon what I've talked about for now close to 40 years. It's the 3-bucket plan. So in bucket 1, you have cash flow, you have emergency funds, you have everything taken care of for the next 5 years. Meaning there's no volatility, there's no fluctuation, there's no risk, you're just set for 5 years. Second bucket is after that fund runs out in 5 years, you've allocated a certain amount that will cover you between years 5 and years 10. And again, Sometimes these annuity guys hatchet this up and tell you to fill those first two buckets just with annuities. I'm not promoting that at all. As a matter of fact, just in the last 2 weeks, we've run across some people here in South Florida that have just been so taken advantage of by these annuity salesmen, and they've not told them about the truth, about the loss of principal, these expensive riders that promise things, because first, the client didn't know enough to read the contract. Two is, I don't even think the agents that were selling these things read the contract because they completely misrepresented them. So just a soft little subject for right now. But to make a long story short, the people that are most emotionally stable in this environment are the people that have a bucket strategy. Now, if you've not been invited to our online platform, our One Wealth Map platform, send us an email. Go online, give us your information. We'll get you a free, no obligation, no catches, access to our online platform. This way, what you can do is you can download or connect all of your accounts, whether it's Fidelity, Schwab, whoever, I don't care. And they will pull all that data into this One Wealth Map software. From there, you can actually see, without some broker or financial advisor maneuvering the numbers to make it look better than it really is, you can really see what you actually have in those three buckets. Because again, if you know that for the next 5 years, there's nothing to worry about, then this short-term dump in the market of 20% in the NASDAQ and now over 11-12% in the Dow, that excuse me, should give you some kind of indication on your safety, and it should give you some solace that there's no need to worry. This is 5 years out. Do you think that these tariffs are a scare tactic to get other countries to come into alignment? Yes. A lot of people are beating up Trump, but there has been a great inequity in our trade balances. Countries, I don't disagree with them, countries have taken such advantage of the U.S. And as we're getting less wealthy as a nation, other nations are getting wealthier because no politician, well, up to date, has held their feet to a fire. Now, with any war, doesn't matter what the war is, there's going to be casualties. In combat war, casualties don't come back. In this war, the tariff war, this is a short-lived experience. And I do believe that most of these countries will get into alignment, because once they start feeling the pain, because they haven't felt the pain yet, right? This is just an initial reaction, and what they've done is counteracted. They've sent, we lob over some artillery, and then they lob some artillery back. They've then imposed their tariffs. And while this hurts, it hurts everybody. Hurts me, hurts you. Prices will go up in the short term, no doubt. And we're going to see some volatility, excessive volatility within the stock markets. That's the short-term pain to get to a place where we are now more competitive. And when we see that Europe and China and the UK is not nearly as imbalanced, but Canada and Mexico, we had an agreement with them. They're not following the agreement. They're abusing the agreement. And so what do? If you have an agreement that's supposed to be fair, you have to hold the other party's feet to the fire. And that's what's happening. So a lot of people are saying, well, everybody's scared in the market. Well, no, if you actually look at the statistics, about 60 to 70% of the market downturn and the selling within the market is actually not from retail trading, meaning individual consumers. And it's actually not even from money managers. A lot of this is hedge funds and the automation that happens when the market goes down. They're actually cashing in on the downside, which even pushes it further down. So what we see in the markets and this big downturn, about maybe 50 to 60% of it is not reality. It's not priced in the accuracy of what's really happening with the tariffs. So to make a long story short, I hate to use these terms because I hate it when brokers tell people without a good plan, just stay the course. But if you have your three buckets, here's what I would suggest you do. Go online to your One Wealth Map software. Click on the investment reporting. It's in the top left. once you're in the investment section, look at your 3 buckets. You'll see how much you have allocated to bucket 1, bucket 2, and then finally bucket 3. Now you're going to see in bucket 3, you're going to see the normal volatility that you've seen within the market. This craziness, right? Bucket 2, you probably won't see very much volatility at all. So if the NASDAQ has dropped, say, 20%, in bucket 2, you're probably down 5%. And that's okay, because again, that bucket doesn't really come into play for 5 years. And in bucket 1, you won't see any fluctuation at all. So hopefully, if you're online with that software, then this will give you the steadiness, the relief of stress. And look, in the end of the day, our goal is really to make sure people never run out of money. Their assets are protected. They've always got the cash flow that they need. And more important than just the financial aspect is allowing you just to sleep at night. Because if you don't know what the plan is, if you don't know how it's structured, and all you're seeing is all this financial propaganda about the world coming to an end, of course you're going to feel stressed. So what do? Make sure you log in and you're looking at your buckets. Anytime you get that little nervous feeling, log in and you'll see, hey, I'm okay. Everything is planned out. And if you're not with our firm and you've decided to go with a financial advisor that simply tells you, oh, just stick with it, you're in a conservative, or just stick with it, you're in moderate, or hey, you're in the aggressive portfolios and just live with the volatility, that's where I would get a little worried, because everybody has a different definition of conservative, moderate, or aggressive. And what might be conservative to one financial advisor might not be conservative to you, or the cash flow that you need. It also might be on the other side. The financial advisor might be so conservative so that they're not losing assets that they're charging on. You may be grossly underliving your ability to live the life that you want. Hey, go check out your One Wealth map, and again, click on investments, look at the bottom, and you'll see your buckets and how much is in each bucket. With that, stay steady.